Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, August 10th, 2019, and I've got the weekly market update. I hope everybody's summer's going pretty good. Things are kind of slowing down, it seems, and doldrums, especially in the uranium market after the 232 decision. There's been a lot of sell-off and no news. But that's what we see in these summer type time frames. Sometimes things just go into the doldrums. Like when the old sailors would come across from Europe, they would sometimes their crews they'd get into these doldrum areas, and their crews would want to mutiny. So I think we see some of that sometimes on Twitter and some of the other places where people are getting very anxious about things. But as they say, sell in May and go away, come back on Labor Day. So we're in the summer, things are slowing down, and we'll talk about that a little bit more in the reality check. So this week's reality check, I wanted to talk about an article I read. There's a guy named Chris Mayer. I'll put a link to this article he put out, but I thought he had a pretty good analogy or a pretty good example about something. This guy's a pretty smart guy. He runs the money for the Bill Bonner Agora Financial newsletter industry. Billionaire Bill Bonner, he runs his family office for him, so he does all of his investments. And this guy's pretty smart. I've been following him for about 10 years. He's a really deep value guy. He's a deep thinker. He's another guy that tries to seek out smart people and use their knowledge instead of trying to invent everything himself. And his article, I'm on his email list, but in this article that he sent out, he was talking about somebody that he was reading, and it was an example of what we don't know when we think we know something. And it's kind of analogous to sometimes our views when we're being investors or speculators. And the example was, if you take a candy thermometer and you plunge it into hot water, what do you expect to happen? And most people would say, well, they expect the mercury to rise and for it to show a temperature increase. But what really happens, if you really look at it and think above what initial perceptions are, is initially the temperature on the thermometer will decline. And that seems, antithetical or not rational. But it's explained by simple physics. So when you plunge the thermometer into the water, the heat is immediately transferred to the glass and not to the mercury. So the glass expands and the mercury inside has more volume. It can initially drop. So the temperature would look to be, for some small period of time, seem to drop. And then as the heat transfers from the glass to the mercury will then rise. So I think that was a good example sometimes of, thinking we know something that's so when it really isn't. And I think that kind of jives, it kind of, some of the thinking I've been doing recently or I've been doing for a while about, how to be successful in the markets. And as I've said before, you have to have some type of advantage. And I think, looking at the headlines, worrying about the trade wars, trying to predict Fed policy or the effects of Fed policy, or if the economy is expanding or not expanding. I think these are mugs games. And, as an individual investor or speculator, you really don't have the ability to really fully gather enough information and then take that information and turn it into some type of strategy. We've heard all the jokes about, the economists predicting, recessions and all that stuff, and the Federal Reserve Bank is never right in its predictions, and these people are PhDs and all kinds of supercomputers and economic models, and they still can't get it right. And even if you could predict these things with certainty, how could you really translate them into an advantage in the market? And with the fact that information about interest rates or some of these other things is instantaneously known and it's priced into the markets, there's really not much of an advantage for an individual investor or speculator. It's just beyond our scope and our ability and timing. So what we have to do then to gain an advantage is that, in my view, and what I try to do, is three things. First of all, you have to be a second level thinker. You can't just look at the obvious news front page. As Don Cox used to say, page 1. You've got to go back and look at page 15 and see that small article that nobody's looking at, or that thing, that event that hasn't occurred yet that is going to occur because of a catalyst. We've talked about this before. I can give example after example. I mean, understanding, like just recent trade that we talked about, the Greek ETF. I mean, the thing's up 40% this year, or thereabouts, 35, 40%. And it was, a situation where we thought things were going to go from terrible to less terrible. Why? Because the previous socialist government, it was very obvious in the European elections that the center-right party won that election. They were polling high for the upcoming Greek elections, or not upcoming, but recent Greek elections. And so, we've seen this happen in Brazil. We've seen it happen in Argentina. We've seen it happen in the U.S. You get this perception of change, that things may go from bad to less bad, and that can change investor perception and sentiment and allow money to flow into a market. So that's an example. I'm talking about second level thinking. You can't just say, well, Greece is a basket case. Who would ever put money in there? Well, Greece and Russia are some of the best performing stock markets this year. And if I just went to the man on the street, or the average investor, and asked him that, he would have no clue that those markets had been overperforming. So it kind of dovetails into, you have to be a second level thinker. You can't just look at, like, say, the uranium market, like some people say, and say, well, people are shutting reactors down around in Germany, and Japan's offline, and there's an unlimited supply of uranium in the ground. Those are actually two factual statements. The Germans have said they're going to shut their reactors down, and theoretically, from at least an economic perspective, at a certain price, there pretty much is hundreds or thousands of years of uranium in the ground. There's a guy that's of Indian background. He makes this argument about uranium all the time. I can't remember his name, but there's plenty of uranium in the ground. Well, that's first level thinking. That's, of course, right. I can go to the USGS website, and it'll tell me exactly how many, estimate how many tons of uranium are in the Earth's crust. What is that? That's really great, but what does that really get us? No discussion about economics, no discussion about the mining cycle, no discussion about what it takes to get to that economic production. And that's the second level thinking that we have to do, that what I'm talking about, and that gives you the advantage. Just being a first level thinker, well, shale has literally went up. It's been going up. Shale oil in West Texas has been going up over the last 8 years. So, it was doing it. It went up last year. It went up this year. It'll go up next year. That's first level thinking. And that's not the case. When you start talking about the declines, and you start talking about the necessary water issues, all the other issues that go into it. And so we've already talked about all these before. What I'm doing as an example is to tell you that you have to get an advantage. You need second level thinking, first of all. You can't just look at page 1 and say, yep, I got it. I'm going to invest accordingly. Because, if you would have thought that, the linear increase in shale production, which has been true, most of those stocks are down over 50%. A lot of them are facing bankruptcy. They don't make any money. So if you went into that and put money into that with that linear first level thinking, you've lost money. So that's number one. Number two is the concept of mean reversion, or reversion to the mean. When something is down 90%, it can still go down another 90%. But if something's down massively and way below where it has historically traded, then I think it behooves us to take a look at it at least and say, is this down? Is this rational? And is there any type of catalyst that may come along? Or is there any type of change that could come along in this industry, or with this company, or with this particular country, that would lead people to believe that things were going from crappy to less crappy? Because if there is, then that represents tremendous value for us and tremendous upside. Now, like I just said, the difference between, something can go down 90%, it can go down another 90%. But I think when something's completely blown out and it's been down for a while, who's really left to sell? When Greece, or the same thing happened in Cyprus, or the same thing happened in, I can go on and on for different, economies or companies or industries. It's the cyclicality, it's the mean reversion and cyclicality in the natural resource sector which gives us another advantage that we have if we use it properly. If we understand that periods of undersupply of copper, for say, will eventually lead to higher prices, but we can't fall back into our first level thinking and say, well, now copper's at $4 or $5 a pound, it'll go to 6 or 7. What we have to say is that copper at $4 or $5 a pound is now going to stimulate a massive tide of investment that's going to bring new production on to take advantage of that higher price and that scarcity, and eventually lead to an oversupply, and that these things happen in, cycles, and we can pretty much time them out. And price is the thing that we have to use as a determining factor. As long as we keep in mind the ascent of man, there's going to be, unlimited demand over time for these materials. We just have to understand the cyclicality and the fact that when they're at their lowest point and none of the companies can make money and the bankruptcies start happening and the lack of investment starts happening, it is not a bad thing. It is the beginning of the birth cycle for a new bull market in these things. So that's the concept of the mean reversion. We know, when Cyprus had its issues a few years ago, the country wasn't going to dry up and blow away. A lot of Europeans go there on vacation. Yes, there's a tumultuous period of time. There's a lot of fear. There's a lot of uncertainty, and money runs away from that. We've talked about that before. But that doesn't mean that the place is going to dry up and blow away. It, over time heals everything. Broken bones, feelings, broken hearts, whatever. It also, can and does heal economies and companies. We just have to identify the catalyst and see if it's relevant and actionable. And if it is, then we have to position ourselves for that move. And if you would have done that, you would have, had several companies that went up, hundreds of percent. So that's what I'm talking about, mean reversion. The third thing is time arbitrage. Talked about this before also. We're not portfolio managers or investment managers in some fund where we have to report to a board or a chief investment officer, and we have to explain why we're buying uranium stocks when they're going down. Because, if you're running a fund, you're talking about monthly or quarterly performance. You have to beat the benchmark. We don't have to do that. We've talked about this before. We can sit here for 2, 3, 4 years, and if we end up getting a 500 or 1,000% return on some of our stocks, and we sat for 3 or 4 years, well, if you annualize that, you're still crushing the benchmarks and the markets. So that's what the other advantage we have. We can sit on our butts and wait. So I just wanted to talk about that. We don't know as much as we think we know sometimes, and we really have to spend some time if you're going to have money in the markets. You can't just throw money at front page ideas. You have to sit down and think these things through and really look deep beyond, and that takes time and effort, and that's why you get paid off. That's what makes this hard, and that's why it makes it so potentially lucrative. All right, moving on. So here's a recent gold chart. It has the data on from last week. Get this off stock charts. It's pretty much no doubt now that we've broken out on gold. It's, I'd say we have been in a gold bull market probably for the last year or two, but we've really got the confirmation now. The one thing I want to caution people on is you start getting FOMO, you start getting the fear of missing out, you start getting the tourist season when the bleacher bums and shoe clerks start showing up, and this is what you get. You're going to get this run up. It's obviously overbought. Nothing goes straight up. I'm just going to remind you. I mean, this is a long-term thing over several years, this bull market. It's not, going to happen in a week or two. So things need to back and fill as they climb higher. So At some point, I think, you can expect a pullback here if you, were hesitating or weren't able to get on board. You don't have to, you're not running after the train. This thing's going to make several stops. And when these things get overbought and sentiment gets way too positive, you can expect a pullback. So I want to clarify one thing before we get into the deep commentary here. I made a video like a couple weeks ago about the gold mining industry and gold stocks. I can see what's going to happen. People are going to want to find that one gold stock that's going to go up 10,000%. And so you got to be careful, guys. If you're a casual, if you're kind of more a passive investor, if you're not doing this, full time or spending a lot of time on it, you got to understand something. There's going to be a lot of companies now. They're going to come out of the woodwork and say that they're mining for gold or they're looking for gold or whatever, and they're looking for investor money. That's one of the reasons why I said for most people to take advantage of this. I think a gold stock ETF. Like GDX or GDXJ is probably a good thing. And if you want to get into individual stocks, I think one of the good royalty companies, because why? They're real businesses. You're going to participate in the upside above the, you'll get a better return than just buying the straight bullion, but you're still also, you're not going to be in danger of the thing going out of business or, like I said, mining is a crappy business. I mean, I have a junior gold mining stock in the portfolio, and it's a single mine company. Now they have the prospects over the next couple of years of increasing the size of the existing mine and getting some other mines going, but there's no guarantee. It's risky. I mean, anything can go wrong. So that's the thing I try to convey. So if you're not going to really get deep into the research, just spread your risk up by buying an ETF or buying one or two of these royalty companies that are established, and you will be able to participate and you will do very well. Now, you won't get the 10,000% return, but, most people aren't going to get that anyways. You're not going to find the needle in the haystack. 1 out of every 3,000 of these prospects ever turns into a producing mine, and that's no guarantee that the mine even makes money. So that's the caution I'm trying to do. If you want to buy, get in here and juice your returns, just be aware of what you're doing. And some people say, well, the royalty companies are overvalued. Yeah, but they're going to get extremely more overvalued in a gold bull market. I can tell you that right now. So, you can't put typical valuations on some of these things. It's speculation, it's sentiment, and it's, people's emotions that are propelling these things. So just wanted to point that out. So had the Geohring and Rozencwajg quarterly report came out. This is one of my favorite things that I look forward to every quarter. These guys, actually, I've said this before, they run a natural resource fund, so they are talking their own book, but they have an enormous amount of information on their website for free. I'll put a link to it. I'll put a link to this report. These reports come out every quarter. They're usually, somewhere between 30 and 40 pages long. There's a tremendous amount of research done, tremendous amount of background they put in there. It's not just some guy on the internet saying things. Lee Geohring recently had an interview where he was talking about this new gold bull market. One thing I'll say about Lee Geohring is back in 1999, Forbes profiled him where he made a prediction that gold would go to 2,500. That was back in 1999. And he stated the reasons why, which he restates in this current commentary. And I'll point out some of his points where he backs up his statements. I'm hesitant to say where he says gold's going to go this time, but he says, based on some of the same metrics that he used to forecast his 2,500 call, and obviously gold didn't make it to 2,500, it made it to around 1,900, but that was still a good move when, 99 gold was selling for about $250 to $275 an ounce, $250 to $275 an ounce, and he was calling for, $2,000 plus gold. It made it to 1,900. People thought he was a nut then. The metrics he used then are some of the same metrics he's using now, and his gold call now, he's saying that anywhere from 12,000 to 15,000 per ounce. I know that sounds wacky. That's why I encourage you to read the commentary. He makes some good points. This guy does know what he's talking about, and that's no guarantee, but he does back up what he says. So a couple snippets from the report. It says, whether you compare the value of gold holdings relative to the amount of money printed by the central banks, the global stock of financial assets, or just the price of the Dow Jones Industrial Average, there is no denying that gold is as cheap or nearly as cheap as it was in 1929, 1970, and 1999. Each of these years proved to be excellent times to have significant gold exposure. And then he goes on to talk about some of the reasons why he thinks gold is going higher. And I like this one. It says, since 1971, there have been 5 times when the gold-silver ratio has surpassed 80-1. That means, if you take the gold and divide it by the silver price, your ratio. An ounce of gold buys, i.e. an ounce of gold buys 80 ounces of silver. And in 4 of those instances, so 4 out of the 5, or 80% of the time, it paid to accumulate significant positions in both metals. Last week, and I think this thing's a little bit dated, but last week the gold-silver ratio hit 93-1, the second highest reading ever. So this goes back to my, looking at setups, looking at, this poker analogy. Okay, so here we are. You have no guarantee. We've got a good hand here. We just got dealt. There's, we know that 80% of the times when the gold-to-silver ratio surpasses 80%, we have significant moves in both metals. We now have the highest gold to silver ratio ever recorded, 93-1. So we're sitting on, we just got dealt 2 aces, and we're sitting in, the best position at the table. So that doesn't guarantee us that this is going to happen, but it puts it in a good situation. Now, there's other factors that he uses also, or that they use in their analysis. But what I'm trying to tell you, this is the kind of stuff, this is what the kind of setups that I look for. Okay, the odds are extremely high in our favor based on previous occurrences, okay, that, we are looking at a move in gold and silver, okay? In the past, it's happened 80% of the time when we see this setup. So the risk reward is very skewed just based on this one factor. Now, this isn't the only factor that they use, and I do look at other indicators or things to persuade me. If you look in Gold We Trust report that comes out every year, it's 200 slides long. They go into a lot of things about debt, money supply, negative interest rates, a whole bunch of factors, and those things are all lining up also. I mean, something's happening out there, folks. Something's not right, society-wise, politically, socially, and I think gold's sniffing all this out. I mean, I've called, everybody's talking about MMT and what happens if Bernie Sanders or the socialists get in there. We already have an MMT president. He's Donald Trump. This guy is a real estate mogul. He loves debt. He sees no problem with debt. We're running trillion-dollar deficits, okay? The ECB is running negative interest rates, and and the economies there are not responding. So they're talking about doing even more money printing. The Bank of Japan has never stopped printing money. I saw an article the other day, the Japanese and the Swiss have already, for years already, have already been in the markets buying stocks. And the ECB, I heard that in a news report last week. Maybe the ECB goes out and starts buying, corporate bonds or even corporate, even stocks on stock markets. So monetary mayhem is coming. It's already here. This whole debt situation is just not going to get fixed any other way. So, I'm not going to rehash all of the reasons why. I'll put links to these reports. I suggest you read them. They're very great. They're good. They cover everything. They get into oil, copper, and they don't just sit in an office and do this. When they were talking about copper, one of the things they're talking about is, the rise in use of copper in India. Where China was, 15 or 20 years ago is where India basically is in its copper consumption and use in its economy. So it's boots on the ground. It's well thought out. And I think that for many reasons, we're in a gold bull market. A couple of charts I wanted to point out from the report. Here's a gold holdings of the gold ETF. You can see as when the ETF came out, how it helped propel the gold bull market as there was steady accumulation all the way to 2011. Obviously as the price went down, there was a big, they had to unload their gold as people sold the ETF. But you can see, started in 2015, there's been a steady accumulation of gold back into the ETF, which is going, it's wind in the sails. So there's been a steady accumulation by investors in the gold ETF. And I think the gold ETF is a good thing that helps, propel these markets when they get going, because, back in the day, it used to be fairly difficult to participate in buying gold bullion. You had to go to a coin shop, or you have to order it on the internet. You have to store it. And this way you can just, pick up your phone and go to your Ameritrade account, and you can buy gold bullion via the ETF or proxy, if you will. But, when that forces the gold ETF, then the administrator to go out and actually buy the physical gold. Now, we can get into the arguments of whether they really do it. I'm not going to get into conspiracy theories here, but suffice to say, we're starting to see accumulation of gold again. And why is that? Here again, we see central bank gold purchases and sales. You saw since 2011, 2010, central banks have been net purchasers of gold. Yet in the West, you will see central bankers poo-pooing and making disparaging, blackguarding the gold as a reserve. But you see countries like China, Russia, Turkey, Iran, these other countries have been steadily accumulating gold. And I think that's partially to do with the fact that the U.S. dollar, is being used as a, weapon of mass destruction by the United States government to, force other countries to do its bidding. But we won't get into that in this particular video. Suffice to say, you're seeing accumulation of gold. And the other thing that's not pointed out here, but I would point out, is it's getting more and more difficult to find gold. When, gold mining or oil drilling, all the easy stuff's been found. So, of course, you don't run out. It just becomes more and more difficult to find and extract the remaining gold. So you have all these confluences coming together, which I think is going to lead to a big move in gold. I don't get caught up in the FOMO. There's going to be pullbacks. We're overbought right now. If you haven't got on board yet, you should be looking at companies, or if you want to get in royalty companies, or if you want to get an ETF. When the gold price pulls back, which it will, you'll get a better entry point. So you don't want to buy at, I still think that you'd probably do well long term, but nobody likes to buy something and see it go down, 20% in a month. So that's it for this week, guys. If you want to help me out, there's a lot of people that kind of want to help me out, but they can't really become subscribers or don't want to become subscribers. You can always help me out here on YouTube by liking these videos and by subscribing. It really helps with the algorithm, and it shows the Borg over at Google that people are interested in these videos, and it puts them in front of even more people. So definitely would like for people to become subscribers to the Actionable Intelligence Alert newsletter. Link in the show notes in the comments. But if you can't and you enjoy these videos, please support me by subscribing or liking the videos. That's it for this week, guys. We'll talk to you next week. Take care.